Hello friends, let's understand the concept of risk and return trade-off. What is the relationship between risk and return? Does high risk essentially mean high return? How do different investment options rank from the risk and return perspective? And how does an ideal portfolio look from the risk and return perspective? So fundamentally, what is a risk and return trade-off? For that, we need to understand what is a risk and what is a return. In finance, risk is a chance or a probability that the investments or portfolio's return will be different from what we expected, which means that the return will be less. If it is more, then that is not a risk. In finance, the risk and return trade-off implies that the potential return rises with the increase in risk. And the entire world of finance moves around maximizing returns while minimizing risk. The relationship between risk and return is such that low levels of uncertainty or low risk are typically associated with low potential returns, whereas high levels of uncertainty or high level of risk are associated with high potential returns, which means if you want high returns, you should be willing to accept high level of risk. The returns associated, of course, are potential. So by taking high risk, there is no guarantee that you will make high returns. The risk and return also needs to be specified. For example, what is the return? If you are investing in an equity, your return is the possible appreciation in the price of the stock plus the dividend that you get. If you are investing in a fixed income security like a bond, then your return is the difference between the price at which you purchased the bond and the price at which you sold the bond, or maybe the price of redemption plus the interest that you earned on that bond. In finance, the risk is measured typically by calculating something called volatility or the fluctuations, and represented typically by the standard deviation. For example, this concept of standard deviation is very widely used in risk. For example, in calculation of value at risk or in calculation of a beta of a stock. Risk return is typically represented on a graph by using standard deviation or risk on the x-axis and the return on the y-axis. So as you will see, it's an upward sloping curve where low risk and low return are towards the bottom side, and then the high risk and high return are on the upside, which means as the risk level increases, you aim for the potentially higher return. It's a positive relationship. Also, when it comes to the portfolio or building a portfolio of assets, we know the common adage that you should not put all your eggs in one basket, because if the basket falls down, all the eggs will be broken. In finance world, it translates into banks going for assets or for borrowers with different kind of risk. They do not aim for only the best class borrowers because they will not pay high rate of interest. Likewise, if you are an investment manager, you will not invest only in blue chip stocks because blue chip stocks are already well priced and they may not give you very high level of return. So you might invest in stocks that will give you high rate of return, for example mid caps or new companies where the potential for return is high, but of course risk is also higher. So an ideal portfolio will include assets of different levels of risk because you are looking at maximizing your returns as well. For example, non-AAA borrowers is what banks will definitely look for. A diversified portfolio could comprise of number of assets. For example, it could have equity. As I mentioned, blue chip stocks which are more stable will give you good returns over long term, and also maybe some of the mid caps and other new stocks. Because you are aiming at beating the inflation. Let's say the inflation is 6% per annum. You want a higher rate of return, and one of the best ways to invest is to invest in equity. You could invest in government securities or bonds more from the stability point of view, because over a period of time the likelihood of losses from these assets is lesser. You may invest in T-bills or treasury bills, maybe certificate of deposits, maybe in commercial papers, because these are liquid assets. These are short-term assets, and the liquidity is also important in building a portfolio. You might invest partly in gold and silver because gold has been looked at as a hedging against any kind of crisis in the financial markets historically. You may invest in hedge funds, for example, which give you high potential return for higher level of risk. You may invest through angel networks, you may invest through venture capital fund, PE fund. These are typically illiquid investment, but they offer a high potential return. Likewise, real estate can be compared on the similar parameter, more illiquid kind of investment, but more secured because you have got a collateral, right? And there is a medium risk and return kind of a profile. Some people prefer investing in cryptocurrencies like Bitcoin and others because these are highly speculative instruments, but the potential of return is very, very high. Also, an ideal portfolio will have something in cash because it is required for the contingencies, and in some case some good opportunity comes up for investment, if you have cash, then you can readily invest in that. So if we map the risk return profile of different assets, again we can create a graph where, for example, T-bills or government securities would be more on the low risk, low return, and then maybe the futures and options could be on the high end where you have high return, but it comes with the high kind of a risk. Understanding this risk and return trade-off will help you manage your own investments better. You will be able to balance liquidity, safety, maybe something like building retirement savings in a safe way, having right kind of insurance, etc. if you understand this relationship well. Also, you can build a good career in risk management by understanding which are the roles in risk management, what are the skills required, how you go about acquiring those skills. Also, you can get right kind of qualifications if you are serious in pursuing career in this domain. For example, Global Association of Risk Professionals, FRM, or Financial Risk Management qualification, or PREMIA's Professional Risk Management or Operational Risk Management qualification. Hope you found this video interesting and useful. If yes, please do like and share this video and also subscribe to my channel. Thank you very much. Take care. Cheers.